Well, probably the busiest people at the moment are asset managers, and Cy Jacobs, the founder and chief investment officer, and the man behind 361 is with us in studio. So first, congrats, man. Your dominance of the Raging Bull Awards for 361 must be something really special. But this is not a day for awards. This is a day for what the heck do we do? And I don't think there's a better one to give us an insight than you. So shoot, where do we go to from here?
Well, thanks, Alec. I think, obviously, I think this has been in the making for some time. I hope, obviously, that this war gets finished as soon as possible. But I think the task at hand is exceptionally large. I mean, that's the truth around it. So, for us, thinking about Iran as 80 times the landmass of Israel can't make it the easiest task to complete. I think the Iranians have had, or the regime rather, in Iran has had many, many decades or years to build up this arsenal, to store it underground, to use whatever means they can to build up this arsenal. And I think as a result, it's going to be a lot longer than anticipated. And I think the damage might be more severe. So, I think that's why we're seeing now on Tuesday morning, a bigger sell-off, because many thought from the Saturday morning strike, maybe we're in for a couple of days and everything quietens down. But we can see that it is escalating. So, from that point of view, and you can see that the U.S., although the U.S. is supporting Israel, you can see there is a divide amongst the world. And many other European countries, for example, that would have been particularly interested in supporting are not necessarily there. And we have Russia and China on potentially the side of Iran. I think it's rather complex. So difficult to know how long this will last. And I think the implications, ultimately will be very positive for the world. If the US and Israel succeed, we may have a new era. But I think for now, it's difficult to say how long it will last and how it will play out, because it's very difficult to create a regime change. And I don't see that happening. I think it's too large a problem, and I can't imagine Israel or the US wanting to go in with ground troops.
It's an interesting piece that we've published this morning from our partners at the Financial Times, where they say that what's happened was carefully planned by the Ayatollah Ali Khamenei, and he actually stayed in his compound knowing that he was going to get killed and that he would be a martyr, but that these plans have now been delegated throughout the armed forces in Iran. So it's almost like you could have pockets who would be continuing to fight, like the Japanese in the Second World War, if you recall. There were little islands where Japanese fighters continued long after the war was over. What does that mean for investments, though? If we take the premise or the belief that this is going to be a long war, not something that'll be over very quickly?
We've already seen, obviously, a spike in oil prices. I think luckily and you've got to take a step back maybe for the US, that potentially Venezuela was done first for this particular reason, that there's a lot of supply that could potentially come out of Venezuela. So once you strike Iran, the impact is not as big, having won over potentially more supply out of Venezuela, but that hasn't kicked off yet. So I think that is inflationary overall. And obviously this market has carried on and continues to do well, particularly on lower inflation, where tariffs haven't had the impact that maybe many would have seen. Inflation has remained low. Low inflation has obviously always been a target of Donald Trump's. And, this could kick off inflation, and then, kind of all bets are off. If we see, gilts and bonds around the world starting to rise, it makes your discount rate potentially higher, it makes equities worth less. And obviously this stifles not only, trade, but travel. People obviously sit back, don't spend as much. We've already seen travel information over the last few weeks obviously declining massively. Obviously, the last few days we'll have zero travel internationally, but it does put a brake on, global GDP. Um, and it's difficult to know how long this lasts.
So, why have the markets not reacted more aggressively then in the wake of what you've unpacked for us? Are you a voice in the wilderness here?
No, I think indices disguise what actually is going on underneath in the market. So obviously, day one, flight to safety, we've seen gold not get quite back to its all-time high we saw a few weeks ago, but again, doing well with other precious metals. And if you look at the market, particularly yesterday, we had strong metal prices and underlying companies that are involved in mining do particularly well, but the balance of the market doing badly. That resulted in overall the index being okay, because today you look at South Africa, almost 30% of the index is made up of gold and PGMs and mining stocks. So it's a big component, and that component did exceptionally well. But you saw what happened, for example, to banks and retailers and property companies, etc. They all came off. I think the fact, and I think that's always initially the initial response to a war, is flight to safety. And regardless, now you can see on the next day when things are still resuming and we're seeing, more and more bombings and, no capitulation from any side, we're seeing an overall retreat. So the market's even a lot worse today than it was yesterday. We even saw the American market recovering yesterday late, on the first day, thinking that, maybe this was going to be short lived. Donald Trump making comments that, in fact, we thought the response would be bigger. Maybe they don't have that much, etc. And then you see into the night last night that there were, quite a bit more launches. You've got embassies being attacked, for example, in Riyadh. So it makes you think that this is more prolonged. And then, we're seeing the second round effects now, which I think will be more widespread across the market. So, I feel that industries will probably come off further. Um, and I don't think it's not an initial one day that you can judge what the effect of this war is.
It's really interesting again to go back to that FT story, because they've spoken to an insider in the regime who said to them that the attacks by Iran were launched specifically as the markets opened on Monday. So they're very well aware of what their intentions are, which is to uh, it's not ideological by any means. It's to hit the international markets in both oil and investor confidence, which means it's trickier than perhaps many people are imagining.
I think it is tricky. I think it's very difficult to believe, to be honest, what comes out of the regime in Iran. So I have a difficulty in knowing whether that's true or not true. I think the real intelligence lies with the Mossad, and together with Israel and the US, I think the amount of intelligence that was in Iran, uh, I don't believe the Ayatollah was aware of he would be taken out with all his heads early on a Saturday morning. I think the amount of intelligence was way beyond, what any of them had expected. We've seen this type of intelligence before with Hezbollah. Um, and we're talking about them having access to cameras. There's even been various ideas pushed forward of how they were tracked, all these heads of the regime. And you get many stories coming out of Iran, and it's difficult to know what's true and not true. Some of it may be panic. I think when you do cut off the head of the snake, you don't know what the result will be. And I think they have done that. And obviously, you are seeing, because it's such a large country and there are so many weapons, you're obviously going to see a while of launches. But I'm not sure if it's so coordinated as you portray. It's difficult to see that being true.
Yeah, the FT is a I suppose they've got their sources and they seem to believe that this guy's got his point of view. But much more important for us here in South Africa is the point that you made about higher oil prices, which is inflationary, which means already we're looking at 16% higher oil in rand terms, and likely to go higher still. What is your advice then to your clients, to the guys who entrust you with their money there at 361?
Well, I think it really depends on the individual mandate, that we have from different clients. So, every client of ours may be in a number of mandates or a single mandate. So, where the client is invested in an SA equity mandate, and that mandate has to be 100% or 95% at least per law long equities. Obviously, we'll try hard in the most cautious of equities, equities with low multiples, high dividend yields, have some gold, have some likes the British American tobaccos, things with high dividend yields, things with rand-hedged capability. As you've seen, emerging market currencies have given up a bit of ground on the back of this strike. So, had you been in pure rand hedges, you've got a little bit of cushion around that. I mean, the indices so far year to date haven't done badly. They've done phenomenally well in SA. So people invested in long only might have taken a little bit of a hit in the last day or two, but overall, over the last couple of months in this year, it's been a very good mandate to be invested. If you're in a balanced fund or a hedge fund, which we also have a large amount of assets under management invested in, there we have been over the last few months reducing our exposure to equities, particularly those equities that have higher betas, in other words, more higher valued shares, those in technology, or businesses front facing of the consumer. And we've moved a lot more into conservative equities, into more cash. In the hedge funds, we actually have a little bit more of shorts. We've actually gone the other way in some equities and reduced our net exposure in the market. So if you took a portfolio of 100 Rand, our nets are more or less running like around about 40. So we don't really have a massive exposure to the market. So that's kind of saying if the markets come off 10%, maybe we'll come off 4. And in fact, we then have options in our hedge fund to try and protect that 4. So the whole idea in a hedge fund is try and protect yourself when you think that the markets will have a deep drawdown or big volatility. So it really depends, So in the long only, you're positioning defensively. In balanced funds and hedge funds, you're trying to take out your equity and rather sit in things that will protect you during these times. And I think it's not a time to be brave, as we're unsure how long this will last. And I think for now, cash is king.
What's the message you're going to be giving at the conference, at the Business conference next week?
To tell you the truth, Alec, I haven't really thought about it that much. So we actually need to have a discussion before on what we're going to talk about. Also, this world's dynamic, so we don't know what will happen by then. It seems like it's a very short way away. It's next week, but a lot of stuff could change by next week. So let's see how it goes. I think if we can focus on South Africa and what's happening internally, I think without this war, there is quite a bit of excitement around, and obviously this has obviously dampened our enthusiasm somewhat. But a lot of good things have happened in the last while in SA, being removed off the grey list, inflation coming right down and sticking around the 3% mark, interest rates reducing, Eskom kind of being partly resolved, people having load shedding, Transnet being massively, started to be fixed. We are seeing a better South Africa. Has it resulted in all sectors doing well? No. Particularly, I think people have been upset by the consumer sectors like retail. And I think that particularly comes from the fact that the economy is better, but money is being spent maybe in slightly the wrong places. We've got, big online gaming spend, which somehow needs to be reined in. And we've got all these importers in Shein and Temu, bringing in goods at a massive rate, which is obviously impacting our local retail names that we used to. When we see an uptick in the economy, we expect those names to do well, and they haven't been. But overall, look at how well financial services have done, insurance and banking and property, as rates have come down. I mean, South African bonds, not too long ago, we were knocking on the 12% mark and we got close to 8%. So, your cost of funding has come down massively. We've seen a big boost in precious metals. So exports going up, our trade balance is looking better, tax collections as a result going to look better. So there's a lot of positive to be gained in the SA economy, and it really feels for the first time in a few years that we've been well positioned. Obviously, this strike and this war will dampen that enthusiasm for a while, but if we can get that resolved, I think that emerging markets, particularly those that are resource heavy, could do particularly well, over the next while. It's also interesting to note how well the South African market has actually done, particularly in dollar terms. Those people who look from abroad generally follow, the MSCI indices, and they look at the MSCI South Africa index in dollars. And in 2025, that index was up approximately 75% in dollars. If you now look at that index over a protracted period of time, it's actually, I think, over 5 years, it's absolutely obliterated the S&P in dollar terms. And I think over 10 years, it's now, or 7, 8 years, it's very, very similar. So, you always make this comment about, who needs to go overseas, who needs to stay here. It's very interesting that the South African market, specifically if you'd played the market right and been in line with the index or even beaten the index, you would have very much been better off in SA in dollar terms than in South Africa at this point in time.
And you've been calling that, and hence your top of the pile performance. Although it's not a one-off. You've been there for a long time. But right now, might we being? I was thinking to myself last night, I'm so pleased I'm not sitting in Dubai, as many South Africans are, or in Doha, or anywhere actually around there in the Gulf region, and very, very happy to be here in South Africa, far away from all the activity. As far as investments are concerned, is there a similar gratitude that we should have by being invested here in South Africa?
I've always said, and I've always made it clear, the South African market is not representative of the South African economy. Let's be honest, what's listed in SA, whether it be Richmond and Anheuser, British American Tobacco, our gold stocks, our PGM stocks, our mining houses like Glencore and Anglos and BHP, the majority of our market cap of the entire, market, the JSE, is not representative of the South African economy. So I think we have enough cyclical factors and enough steady companies that, yes, this region, obviously is affected by the world, and valuations are very closely linked to what happens globally. But the market has enough here that you're able to guide yourself and hopefully make a reasonable, return over time out of indices, or sectors rather, in South Africa. I think obviously the one that everybody thought we'd missed out of, we only had really one technology stock, being Naspers and Prosus, which is solely reliant really on Tencent and hasn't done exceptionally well, Tencent of late. But then again, as you've seen in the last few months, your Magnificent Seven, outside of the chip makers like Nvidia, etc., have done particularly poorly. And everyone thought, well, why be invested in South Africa? Because we don't really have any tech here. You've got to be in Microsoft and Google and, Nvidia and Meta, etc. Well, they also have their time where they don't have such good cycles. So, there's a potential risk in investing in very high valued stocks. Like we've always had discussion on Tesla, for example, which still remains very high. But I think overall, there is an element of safety in South Africa, and you have a lot of valuation on your side. You have reasonable dividend yields. You have PEs that are not too high. And when you do get pullbacks, you generally find a little bit of a cushioning in the weakening of the currency. And because we have a large component of rand hedges listed here, that generally does give you some safety against particularly other regions.
Just a last point. In the budget, the offshore allowance, discretionary allowance, was doubled from R1 million to 2 million rand, which should be celebrated widely for the fact that exchange control is now becoming less and less of a factor in most people's lives. But for you as a guy who looks at the whole world and the way that your portfolios are structured and the way that your clients can invest in it, is this a good thing for you?
I think it's an absolute non-event, to be honest, from 1 to 2 million. I think, as you know, both SARS and SARB don't mind you actually taking money offshore. In fact, they would let you allocate whatever number you are worth probably offshore, as long as they're able to keep that amount of money in the South African net, and you as a resident South African taxpayer pay the correct amount on all your earnings globally. So obviously, to do an allowance of greater than 2 million, you would need to actually apply to SARS and SARB and get the requisite allowance. But if you're a good taxpayer and you're up to date, then those allowances are generally allowed. I mean, sometimes you do get audited, etc., but really there isn't a restriction when it comes to that. So the 1 to 2 million is really for those investors that don't want to go through any process. And I think what was happening a lot is that many people were traveling internationally continually and often breaching the 1 million rand cost. It wasn't really around the investment level so much as it was about spend happening on international credit cards and flights, etc., and landing up, for their whole families exceeding the 1 million rand, and then running into trouble that they actually were greater than this without even necessarily meaning to invest offshore. So they've just lifted that limit, I think, to allow people a bit more freedom. The real investments have come way above the 2 million rand mark, I think, for a lot of wealthier people in the country. And that process is very regulated, and there's a lot of reporting back to the South African government. And as I've said, as long as it's in the net, there's almost no limitation for what individuals can take offshore.
Just to summarize, for the way the investors should be looking at this at the moment, if I read you correctly, you're not expecting this to end quickly. It could be a long war, and as a consequence of that, you need to exercise patience and really OCOP.
Yeah, I think just being around for a long time, it's impossible to call it. I mean, it could end in the next few days. Maybe maybe there's a negotiated settlement. What I am seeing is no regime change. I can't believe that it'd be that easy to change the regime, regardless of who's not there. And we saw when we saw Hezbollah being attacked and the total regime being removed, we can see they even re-entered the war alongside Iran as a proxy in the last few days. So it doesn't seem like it's very easy to create that kind of change. But you want to take the big threat away. I mean, technology was changing at a rate so fast that I think both the US and potentially Israel were scared of what could be manufactured. You've seen what drones can do now and how little they can be picked up, and supersonic missiles that are actually traveling at 6 to 7 times the speed of sound. So there's a lot of new technology which is exceptionally dangerous, and you can't allow, a regime that has this type of view on the world, to possess those types of weapons. So I really don't think there was a choice, whether you argue it was now or later or before. This has to be dealt with, and we're going to have to go through the pain. And while we're going through that pain, I think we just be a bit cautious in our investment stance.
And if you had investments in the Middle East, in particular the Gulf states, which now no longer appear to be as safe as they were, well, certainly they're not as safe as they were before, is that a red flag?
I think it's definitely a valuation adjustment. I think that is important. I mean, they were never really superly highly rated. Funny enough, the exchange that's done unbelievably well, and that did unbelievably well even yesterday, was actually the Tel Aviv exchange. If you follow the Tel Aviv 25 index, I think over 3 years it's up like 170% or dollars. And if you go back to the invasion in October the 7th, a couple of years ago, since then the market is close to the best performing market in the world, and continued to do well because it saw maybe the potential post this war for a better Middle East. And I think what definitely has happened, obviously, by Iran attacking some of their Arab neighbors, is this has potentially strengthened the Abraham Accords and strengthened the ability of Israel to work together, call it with their sensible Arab partners, in a greater future for the Middle East.
Fascinating. Sir Jacobs, the founder or co-founder of 361. I'm Alec Hogg from biznews.com.